Can a tiny country like Singapore that imports almost everything protect itself from rising global prices? Turns out, it can. Singapore is a small, open economy and one of the most trade-dependent countries in the world. Along with another small economy, Hong Kong, Singapore's trade to GDP ratio is more than 300%. The total value of what it imports and exports is over 3 times the size of the goods and services it produces domestically. Compare that with giants like China and the US. They have a much lower trade to GDP ratio because of their huge domestic markets and do not rely as much on exports and imports. Here's the thing, being so dependent on trade is both a blessing and a curse for open economies like Singapore and Hong Kong. Global trade gives them access to markets around the world, driving growth. But when a crisis hits and jolts the global market, these countries are the most vulnerable to recession and inflation. Take the 2026 Iran war oil crisis. Tensions choked one of the world's most critical shipping routes, the Strait of Hormuz. Oil prices surged, having a ripple effect everywhere, driving up costs, including in Singapore. If Singapore can't control rising global prices, how does it protect itself then? The Singapore dollar, or rather, how the central bank manages it. The Singapore dollar is managed against a basket of currency of its major trade partners. This could include the US dollar, renminbi, euro, and many others. But the exact composition remains a national secret. When global prices rise, Singapore lets the Sing dollar strengthen or appreciate, and that helps cushion the blow. Let's say this chocolate bar from the US costs 10 US dollars. If the US Singapore dollar exchange rate is 1-to-1, you pay 10 Singapore dollars for it. If the Sing dollar strengthens and 1 Singapore dollar has the same value as 2 US dollars, that same 10 Singapore dollars is now worth 20 US dollars. You can get 2 chocolate bars instead of 1. Same money, more goods. A stronger currency cuts both ways. While imports get cheaper, Singapore's exports get more expensive for everyone else. Isn't it bad business for its export sector?
Our exports were never meant to be low cost, and so the people buying it kind of already know this. For things like semiconductors, so much of semiconductor demand is driven by the AI boom, so a lot of it is price inelastic, right? No matter what price you have your semiconductors at, there will still be demand for it. For these firms also, they import raw material, they import like intermediate goods. So, a cheaper import for this kind of people are also helpful to them.
Countries such as the US have a different weapon to fight inflation: control of interest rates. The number you pay attention to when putting money in the bank or taking a loan. That's something that isn't done in Singapore though, but more on that later. When inflation rises, central banks like the US Federal Reserve push up interest rates. Why? Because borrowing gets more expensive. If you take a loan from the bank, a higher interest rate means you'll pay back a lot more over time. So you think twice. Consumers pull back on spending. Fewer big purchases, fewer loans for homes, cars, everything. Businesses do the same. They hold off on expanding, hiring, and investing. And when people and businesses start spending less, demand slows, prices cool off. If interest rates are such a powerful tool, why can't Singapore just use that too? In theory, a country can control both its interest rates and its exchange rate. But to do both, you have to give something up. And that is capital mobility, how freely money moves in and out of your country. We are talking about restricting investments and even limiting people from converting their currency into foreign currencies.
For Singapore, we chose to fix our exchange rate not in a hard peg, but in a floating, we still manage the policy band, right? So that's considered a fixed exchange rate. We allow free flow of capital, obviously, because we are a financial hub. And so because we choose this tool, we need to give up our domestic monetary policy.
This trade-off is called the impossible trinity of monetary policy. The trinity has 3 sides: control over interest rate, control over exchange rate, and free money or capital. Except a country can't have all 3. It only gets to pick 2. Let's imagine a country. Call it ABC Land. ABC Land wants everything. It wants to control interest rates, keep its currency stable, and allow money to flow freely in and out. So, it raises its interest rates. And higher rates attract overseas investors looking for better returns. To invest in ABC Land, foreigners need its currency. They start buying more ABC dollars. This increase in demand will cause the value of ABC dollars to rise, appreciating the currency whether ABC Land likes it or not. But ABC Land has a problem now. It wanted to keep its exchange rate stable, but the market is pushing it up. The only way to stop the ABC dollar from appreciating is to limit foreigners from buying the currency. In other words, giving up capital mobility. You cannot have control over all three, hence the name Impossible Trinity. Actual countries choose different priorities and trade-offs. The US allows its exchange rate to move freely because it has a huge domestic economy and doesn't rely on trade the same way smaller countries do. Plus, the USD is privileged as the world's reserve currency and enjoys a huge demand for it regardless. So what does the US choose? Control over interest rates and free capital mobility. What about China?
For China, they have chosen to manage the exchange rate, not in a strict sense. Obviously, the renminbi is clearly allowed to float. There is a weakening bias now in recent years, so they've chosen to manage the exchange rate. So PBOC does set domestic monetary policy, and as a result, you do need to restrict your capital inflows and outflows. There is a USD 50,000 cap for individuals to invest outside China. For inflows, the kind of investments coming in are obviously screened by their government, their ministry, either through a quota or through strategic sectors that they do want to develop.
Then there are places like Singapore and Hong Kong, small and deeply plugged into global trade. They generally choose to manage their exchange rates to protect themselves from global shocks and price fluctuations. And in return, they give up control over interest rates. Singapore can't control global prices, but it can control how much Singaporeans feel them. And that's a strategy for a country that imports almost everything.